All right, welcome everyone to part 7. We are almost done with this 8-part series. We have this video and one more left. If you guys have liked what you've seen so far and you agree with anything that's been told so far, make sure to leave a like on this video. We would highly appreciate it. But if you can guess what the next tool you should never use is, congratulations, you're smart, because I'm assuming you saw these moving averages on the screen. So if you don't know what a moving average is, it's pretty self-explanatory. Basically, it is a line like this that averages out the last however many candlesticks. So for example, this black line is the average of the last 200 candlesticks. And that's kind of why, because sometimes price can be super choppy, so people can get very confused and not really understand what's going on. And this moving average really allows them to indicate which way the trend is going. And obviously you want to trade with the trend because the trend is your friend until the bend at the end. So this moving average is helpful for a lot of traders, and this is probably one of the ones that I see on almost every trader's screen. A lot of people know why they use it. A lot of people have no idea. They just think it looks nice, and every Forex guru has taught them to do it, so they put it on there. But the reason that I don't want you guys to have this moving average on your trading is because, well, number one, it's an indicator. Now, if you haven't seen the episode on RSI, I recommend you go back to that because I talk a little bit about indicators. But basically, I would say never, ever, ever trade with any indicators on your screen because every single indicator is lagging. And the reason for that is because each indicator needs to take data or some types of values from the candlesticks, and it puts it through this mathematical equation, and that's how you get your moving averages or your RSI, your stochastics, your Bollinger Bands, whatever. But no matter what, price action is the only thing that's ever up to date, whereas moving averages will always kind of change and move around because they don't take into consideration the active candle, and so they wait for that candle to be done. But moving on, so averages are always lagging, and you wouldn't want your video games to lag, you wouldn't want your TV to lag, you wouldn't want your car to lag or to start and stop. And so why would you want your price action, your technical analysis on your charts to lag as well? That doesn't make any sense. If you don't want it to happen in real life, why are you using it on your Forex charts in order to hopefully make money? To me, it just doesn't make sense. And these things just don't work because they don't give the right types of data. So moving on, a lot of the way that people use this, or that you'll see people say that this works, is sometimes people would love to trade when there's a bounce on these certain lines, these moving averages, or a lot of people would love to trade when these cross over. Another one is people love to trade in the trend. So if the trend's going up, people are only buying, or people just use it on there because they think it looks nice, or whatever the reason may be. A lot of traders live and die by these moving averages, and I just don't understand why. But 2, maybe even 3 reasons as to why I highly suggest you don't do it. One is obviously it's an indicator. Indicators, in my opinion, are bad. Number 2, it's just not reliable, because even though you may see this bounce off of here, by the time you see this bounce and you're actually taking the trade, price can be anywhere around here or even up here, because again, these are lagging, so these data points don't really ever show until it's already happened. So a lot of people will say, when you see price cross over, sell right here. But what a lot of people don't realize is by the time this crosses over, price is actually already down here. So if you're selling in this area, where's your stop loss going to be? It's going to be where it crossed, above the high, and then where's your take profit going to be? All the way down here or down here? Because I mean, realistically, if this is your target and this is your risk to reward is less than 1-to-1, and you never want to do that, because now you have to be correct more than half the time in these markets, which can be extremely difficult. So that's one reason. And then obviously the third reason is if you guys have ever heard of baby pips, It is basically a website where it teaches you all things Forex that you need to know. Now, one thing that I always just continue to say is if it's free and it's easy, it probably will not work in the foreign exchange markets. So if you can find these types of strategies online, on websites for free, and there's nothing to it, then usually there's a reason for that. And you have to ask yourself, who do you think is actually creating this website? Who do you think is putting this education out? It's probably the people who want retail traders to lose. And obviously you can click on what are moving averages. It'll give you a complete breakdown of what they are, how to use them, why they're so good, and then you can continue to, the simple and exponential and all that stuff. But again, one thing you have to ask yourself is who's putting out this education? Who wants you to trade like the retail traders, and why are they doing it? Because again, what I've been saying through this whole 8-part series is when you understand who's in control of these markets, who's manipulating these markets, who wants you to lose, you will then understand how to actually start making money instead of continuing to trade without knowing why you're actually doing this. So this was part 7. We have one more to go, which will come out tomorrow. If you guys have stuck around this far, if you guys have enjoyed this to this point, we would highly appreciate if you left that subscribe and like down below, and we'll see you guys in part 8.